Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It's a really exquisite hour for Global Wall Street on a Monday. Dive into some conversations. Matt Hornbach from Morgan Stanley will be with us, and critically his tenure in Japan for Morgan Stanley years ago. Helene Ray, you may not know the name. Helene Ray, R-E-Y, is exquisite on European macroeconomics. And again, we'll look at the transatlantic picture there. But what Paul and I wanted to do was give you just a tone of the equity market. There's no one better to do that with a lengthy conversation with Lori Calvasina of RBC Capital Markets. Lori, I said this at 7:01 this morning. I was thunderstruck by the repetitive, not gloom, but timidity and tentativeness this weekend in equity pundits. I mean, everybody's rationalizing a nervous market, all this history, that. Are you that nervous?
Hi, so thanks for having me, Tom. Look, I would say that I feel pretty neutral on the back half of the year. And I know that everybody hates it when equity strategists are neutral because we're supposed to have high conviction and come in and pound tables and those sorts of things. But I do have some things that are concerning me. I sat down with myself, sort of around the July 4th holiday when we were sort of resetting the second half outlook and said, how much downside do I think those things are worth to me? And to be honest, I didn't feel like we were due for another growth scare or retest of the April lows. That, I do see some things that I think can challenge us a little bit in the short term, but they feel to me like garden variety type pullbacks, which are in the 5 to 10% range, and never fun, but something that you can recover from.
Well, but that's normal. We've forgotten. Paul, help me.
Sure.
Corrections are normal.
Yes.
Am I right?
Absolutely. And
I thought the gloom this weekend was comical. We're in this. I mean, come on, Paul. We're up. Annualize it. We're up 14% on a 12-month forward basis.
Yep. And look where we came from off that bottom.
I'm lost.
So, Lori, I guess maybe one of the key issues for investors these days over the next coming weeks will be earnings. And we're very, very early into this earnings cycle. Is there any takeaways, plus or minus, or are we just kind of plugging along here?
Yeah, and look, I think it kind of circles back to, some of the comments Tom just made, right? So we've come off week one. There was sort of a drizzle of early reporters that came in prior to last week. And I think, maybe this has contributed to some of that timidity or a little bit of caution. But what I heard last week from the financial companies in particular was everything is fine. The consumer is resilient. We're managing through. We're talking to all our customers. This is what we're hearing. But at the same time, I was seeing words like guarded. And there was definitely some conservatism that was still going into the outlooks. And remember, these companies are not on the forefront of tariffs for the most part that we heard last week, but they were still referring a lot to the uncertainty and the policy backdrop there. So was there maybe a little bit of scarring that's keeping them a little bit, vigilant and on guard going forward? Absolutely. And that to me was the biggest takeaway.
Dumb question. Are Fed rate cuts good for the stock market?
I think that the market had gotten maybe a little too optimistic in the short term about thinking the rate cuts were coming soon. If you look at our rate strategy team, Blake Gwynn actually pushed his call recently from September for the first cut back into December. And as I was talking to investors back in June, Tom, sort of running all around the country and talking to people, and part of the bull thesis was getting those rate cuts sooner rather than later. So I think as we dial down some of the short-term implications or short-term expectations for Fed cuts, I think that could cause a little bit of angst in the market in the short term. But I do think, going back to Blake's call, he's pushed those cuts into next year. So it does feel like they're coming. I think if you were to take them completely off the table, that would do, some damage. I think that pushing back the rate cuts because of a resilient economy, and to kind of wait and see on inflation, I think the market, can absorb that without a ton of damage, but it may create some short-term hiccups for a market that's come so far, so fast in a short amount of time.
So, Lori, August 1st is going to be another date on this whole tariff discussion. It just feels like the market maybe has gotten complacent about tariffs and the risk they may present in terms of economic growth or inflation. maybe we're going to get refocused come this August 1st deadline. How are you thinking about that?
I think that's a great question. I'll tell you, my macro colleagues and I at RBC, when we compare notes on the tariff discussion, we're sort of like, is anybody bringing up the deadline in your meetings? And it's like basically no, is what we're hearing across different asset classes. And I think there has been a view, when I've proactively brought it up with investors that, we're seeing a lot of, I don't want to use the word theater, right? But I think there is an expectation that there is, sort of an image that's going on and things are going to be pushed back and things are not going to end up being that dire. Where I shake out, Paul, is I do think that we're going to have more tariffs than what we had to start of the year. And I think that there are inflationary impacts. So where I'm concerned about complacency is when I have investors coming into me and saying, hey, we got this soft CPI print. See, tariffs aren't inflationary. And I just don't think that's realistic. I think companies have been working through a lot of inventory and they've been putting plans into place. And you're starting to see those gears of price increases turning. They're just turning very slowly. But to be honest, this isn't that different from what happened back in 2018. Yeah. And if you look at 2019 earnings, they were flat with 2018 for the S&P. So I worry that investors are kind of saying, hey, we're not getting anything and we're just going to get stuff later and it's going to actually impair the outlook for next year a bit.
We say good morning to all of you on your commute across America. Good morning on Sirius XM channel 121, 99.1 FM, Nathan Hager Radio in Washington, 92.9 FM. Huge response for Arnold's out in East Orleans today.
I just looked at that. It looks yummy.
It's killer. It's like my childhood. I'm looking, Paul. August 1 is like this big date. Mm-hmm. I'm not focused because I'm looking at WWE SummerSlam, the 2-day combo ticket out at MetLife Stadium.
Yeah.
The seats I deserve are $930.
Sure, that's
for SummerSlam.
Yep.
MetLife. And with Lori Calvasina, I'm looking at this fixation here, and it's just an excuse to get in cash. Is there any value to cash right now? Or does Lori Calvasina say, forget about the WWE SummerSlam, you got to be in the market?
Well, look, I'm an equity strategist, right? So I'm always going to want you to be investing in stocks. That's just sort of the nature of the beast. And we did, sort of take the approach, when we've had conversations, especially I would say with newer, younger investors this year, of it's always impossible, to sort of in real time call turns in the market. So, I think clients have been sort of doubting their own ability to sort of forecast some of the noise coming out of DC and some of, the drama and the headlines and say, I have sort of a reasonable expectations of where things are going to be next year. Let me just kind of ignore the short term and position for the long term. And I don't, I think it is a little early to be looking at 2026, but I sympathize with the impulse. I do.
Small cap, mid cap, relative to what I think I hear most often, which is large cap growth. So how do you think about different market cap plays here?
So it's a great question. I mean, if you look at the hedge funds, they like to place small caps on dialing up and dialing down Fed expectations. And I think we're in the moment of kind of dialing down short-term Fed expectations. And these folks tend to be short-term in nature. They're not making 2026 bets yet. And so if I'm, sort of in the process of taking small caps, I think that, it's hard for me to see the short-term outperformance pop from that perspective. I also think that smaller cap companies have a harder time managing around issues like tariffs. I've been reading some non-S&P transcripts recently, and I've absolutely seen that in some of the prints that I've looked at. And I think you want economic tailwinds back, and that's like 2.5% GDP, NFP ramping, ISM manufacturing moving up. I think, if I look across the street, the expectations are for a sluggish economic growth backdrop for quite some time. So people are trying to get bullish on small caps. I'm really kind of scratching my head on the timing.
Lori, thank you. That was brilliant. And the issue here, Lori Calvasina, is we've been trying to get bullish on small caps for what, 10 or 15 years? I mean, it's ridiculous. On the large cap question, and you're going to say, well, it's not something I really look at, but come on. Everybody listening is wedded to 10, 20, 30 stocks. What's that vision out 3 years? So
look, we do work on that. We put our our horizons a bit broader as well. And look, I would say if I'm thinking very, very short term, we do often see the mega cap growth stocks sort of cede their earnings leadership and cede their performance leadership during reporting season. So what do I mean by that? Well, you tend to see outside of reporting season, the rate of upward revisions or earnings sentiment is really, really strong for the top 10 companies relative to the rest of the S&P. And that tends to catch down during reporting season as people actually start to think about the other companies. And then you see a little bit more relative excitement there. So we may be heading into something like that now. If I'm thinking out, the next few years, I'll tell you what I've been hearing on the road from investors is maybe a more rational view of where AI is headed. And it's, kind of moved from instant gratification and instant, sort of injecting optimism into earnings, at least outside of those, top mega cap names. It's not going to be the thing that fixes, things for everybody right now. But I think companies or investors are realizing that companies, it's just going to take them more time to get this technology right and additive to earnings. And if you look out, longer term earnings growth forecasts are still stronger for the Mag 7 than the rest of the market. They're just slowing down a little bit.
Okay, but you don't do an individual stock. There's a small company in Redmond, Washington. We won't mention it. And the bottom line is it's got a 38 multiple. But the answer is out 3 years, a Lori Calvasina short term, out 3 years, you just assume they earn their way into a denominator, which makes a 38 multiple right now rational, right?
Well, what I'll tell you I'm seeing in my deck, Tom, and Tom, you and I have known each other a long time. I am sort of like anti-theme, anti-fad. Like I am never, sort of drinking the Kool-Aid on the next hot thing. But I've been calmed down a little bit on this AI theme because when I look at the top 10 mega cap names in the S&P 500, which are largely AI plays, and I do a median PE of those companies, and I compare it to the long-term growth expectations, and I take those two things, right, and I look at Mag 7 versus rest of the S&P, the relative PE line is the same line as the relative long-term earnings growth line. So they're getting different multiples, but it's based on the differing perceptions of what the long-term earnings growth rates are. And that's been very similar to what we tend to see over time. I think there was a breakdown in that relationship around the GFC briefly, but this is even how stocks behaved back in the 90s and early 2000s. So I think you've really got to tackle those long-term earnings growth expectations, and you've either got to just like bang down the Mag 7 trade and say their numbers are way too optimistic, or you've got to look at the rest of the market and say it's way too pessimistic and move those up. And we're just not seeing any change in that relative gap. So they're kind of each getting the relative PE they deserve.
Right. That's the key issue, Paul, is we haven't seen a change in the zeitgeist. Everybody's publishing and all that, opinions and that, but it's still the way it is. Paul, get one more in here with Lori.
Valuation here. Lori, how do you kind of break that down for your clients here, just of the market in general?
So look, small caps, had hit recession lows on April 8th, and they're now back to average. So they're fine, but they're not super cheap the way they were. S&P, if I look at a market cap weighted multiple, never got cheap, did work its way down from peak, and now it's right back up to peak. If I look at rest of S&P and just do an equal weighted multiple over there, I think we're trading around 18 times. It had been down around 16. Again, never got to average, but it's not quite back to peak. So I feel like in the short term, there's a little bit of a catch-up trade that the rest of the market needs to do relative to the Mag 7. You can watch that Russell PE really closely because what it did this past time was peak out around the 2016 through 2018 highs. We're way far off from that yet, so maybe that's an uber bull argument. But I see different valuations in different parts of the market, and the cap-weighted S&P is getting worrisome again.
Lori, thank you so much. Lori Calvasina, terrific brief there, RBC Capital Markets. What we like to do on a Monday, folks, is on equities, bonds, currencies, and commodities.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Just one of the things we're doing here, mid-July into a July 30 Fed meeting, earnings coming out, Stellantis. Isn't Stellantis Chrysler?
Yes.
But it's a combo like
Fiat, I think.
Fiat, Renault, Puget.
Yep.
Like, I don't know what's in there.
I don't know.
Bob Michael's looking at me like, Tom, you're butchering the pronunciations. We started with Troy Gajewski, then Deborah Cunningham, and now Bob Michael with us with JPMorgan here. And Bob, my great theme is over the weekend, just lots of be careful. There'll be a lot of worry and caution and all that. I looked at a famous blended bond market fund, not JPMorgan, And I think year to date, if I make it an annualized statistic, is a 6.5% return in the bond market. Things aren't that bad, are they?
They're not. There's a phenomenal resilience to both the U.S. economy and U.S. markets, or bond markets globally, to be honest. If you look at some of the things that have gone on this year, none of them are good for the bond market. You've got tariffs. That means higher prices, higher inflation. You've got the One Big Beautiful Bill Act. That means a lot more spending, which supports higher prices. Each of those two are north of $3 trillion. Then you have the Sell America noise out there constantly. That should be putting pressure on U.S. bonds. And then there's talk of global issuance in bonds going through the roof. You're seeing some of that. That should put pressure on bonds. But through all of that, here we are with the 10-year Treasury flat to the Fed funds rate where it's been for most of the year.
You're grabbing the coupon. Maybe make it a little bit.
You're getting the coupon. And as long as there's no recession on the horizon, you're buying credit and picking up the incremental yield.
Where do you see value in credit these days? Because, again, it looks to me, I'm just looking at the INGO function on the Bloomberg terminal, the best performance has been U.S. corporate high yield.
It has been. And we've always said in any backup in high yield, you buy it unless you think you're going into recession. Okay. Then by definition, that's when you worry. That's when you get out because there will be de-risking. That's when corporate profitability drops and everyone's worried about defaults rising. But the reality is there's a ton of money on the sidelines looking to get into the bond market. Both institutional and retail investors feel under-allocated to fixed income.
Can I ask a rude question?
Sure.
First one, a Monday rude question. At JPMorgan, how much is a ton of money? Like if somebody shows up, is it like 100 million? What's the measurement of a ton of money?
Bigger than a couple bushels.
Yeah, exactly. So why are they underinvested in the market? Because for the first time in 15 years, we can actually get total coupon return here. Why are they underinvested?
Yeah, that's, as you just said it, the first time in 15 years. It was the 15 years before that. The zero and negative interest rate policy, people looked at bonds and said, not going to do it, and either left money in cash or went into alternatives. Now they feel over-allocated to alternatives, under-allocated to bonds.
And now our Global Wall Street question of the day, adding in your interns / junior analysts, whatever they're calling them at JP Morgan.
Summer analysts.
How many people are under Bob Michael? Just 2,000? 20,000?
No, 400-ish.
400-ish. How many of those people have never really seen a coupon, Mark? How many? This is all new. Out of 400 people, seriously, out of 400, how many is this all new?
No, you're right. The majority of people in our business have been in the industry post-Great Financial Crisis. So central bank intervention, distortion of bond markets looks normal, whereas we as a franchise, the broader JPMorgan Chase, feel we are going back to a world that existed pre-financial crisis.
When Russia blew up, I went back and read the history of JPMorgan in Russia in 1907. That's how far back they go.
Exactly right. What a history. So our Federal Reserve, how are you parsing through the noise and so on about leadership at the Fed and then getting down to where policy may shake out for the Fed?
Well, I do believe that the Fed members, the FOMC, do come in every day, look at data, and try to make the best possible decisions. So they understand the importance of their role. They understand the judgment that history will make. They get all of that. They're in a difficult position because they know prices will go up once the full strength of tariffs hits. And maybe even this quarter, there will be more pass-through from corporate America. They also feel that it could slow down growth, that if there are higher prices, businesses and households will probably spend a bit less. So why not just hold rates where they are for now and see some of these impacts in the real data? I think that's the right thing to do. And as we start out with, markets are doing great. The economy's doing fine.
And Paul, importantly, the zeitgeist this weekend, Mr. Besson sitting on the couch in the Oval Office, suggesting to the president slow things down.
Yep, exactly. I'm looking through your notes here, Bob. One of the things that jumped out at me is local emerging market debt. Talk to us about that. How do you think about emerging markets today?
Emerging markets in general have been overlooked for the last 7 or 8 years. And when we look at flows into different asset classes, they've gone into equity. Some have trickled into different parts of the bond market, but with shocking consistency, there have been outflows from emerging market equities and emerging market debt. So they've been orphaned, yet they've done well. And this tells you that there's greater support in emerging market debt than crossover buyers, investors like me who run global aggregate funds and look at emerging markets as an out-of-benchmark bet. When we look at the emerging markets, they have very high real yields to them. They've got central banks who are as efficient as any central bank in managing policy for growth and inflation. And they also have the benefit of very strong domestic support. There are wealth management platforms, pension funds, and insurance companies that go in and support the local markets. We can get higher real yields. I can put together a portfolio of South America and Europe and parts of Asia that will yield close to 8%.
8% nominal.
Yeah. 8%.
And what's the real yield off that? Get out over 3%?
Oh, yeah. It's going to be close to 4%.
What's a tension point on the 10-year U.S. real yield? 1.93, 1.94 this morning by my measurement. Is that like not 4%, obviously, but like 2.5%? Our world changes?
Yeah, it's amazing the amount of disinflation and deflation we had pre-COVID, the amount of inflation we had during COVID.
And now we're going the other way.
And how break-evens somehow always hovered between 2 and 2.5%. Above 2.5% would worry me.
The late, great Stanley Fischer told me the day Paul Samuelson threw the chalk in the room and almost bounced it off his head. When you're lecturing the cherubs at JPMorgan on the real yield, have you ever thrown the chalk when they say it doesn't matter? Have you ever gotten upset in a lecture on the inflation-adjusted yield as a residual?
I hear a lot of things that make me upset, but I've been in the markets for a long time.
Right.
You just absorb it and move on.
I can't say enough, folks, that wisdom, their nominal GDP and real GDP dynamics, and nominal yield, the current yield, the one we all know, is in the real yield is the residual after you take out inflation. And those dynamics you have to tattoo to your brain and massage every single day of your career to keep up, like with people like Bob Michael. Bob Michael, thank you so much for JPMorgan.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There's a point in Hong Kong, and it's confusing. There's two mandarins. There's the old mandarin, and there used to be an M bar, and I did something new with it. And there's a new mandarin. If you go over by the old mandarin, across from the charming little trolley car is the fortress of the Hong Kong Shanghai Banking Corporation. And as you can imagine, HSBC, yes, out of London, but so much out of Hong Kong is absolutely definitive on all the stuff that makes it go. Driving that, and our guest in studio here in New York today, is one of the most important voices in semiconductor. Otto Wharton, frankly, joins us with HSBC this morning. You're giving a lecture in America on the Pacific Rim semiconductor market. What's the first thing you talk about?
I think when you think about semiconductors, it's the dominance of where Asia is, especially where Taiwan is in terms of how dominant TSMC is. I think people often now are starting to recognize how important that supply chain is right now.
I mean, I look at I learned this. Taiwan is 70% owned by the foreign people that
Foreign
HSBC represents in that. Would that change at all within the geopolitics? Do we just still see a dominance of international investment in Pacific Rim semiconductor and technology?
Yeah, I mean, TSMC is 75% owned by foreigners, foreign investors. But also, I think this past year, there's a lot of changes because they're now spending more money and production in the U.S. So they've talked about 30% of their most advanced 2-nanometer production will be in the U.S. over the next few years. So I think this investment process has been surprising, frankly, to most of us in terms of how quickly it's moving into pace.
So how do you and your clients think about global trade tensions, tariffs, just the instability it seems like in global trade? Because your business, the semiconductor business, the technology business is truly a global business, global supply chains everywhere. How do you guys account for that?
I think like most industries, everyone's dealing with the uncertainty around tariffs. But I think what's different is the importance of semiconductors right now in the global economy, especially with AI, right? It is such an important engine of all the AI and infrastructure investment. So I think there is going to be, there will be ongoing uncertainty when it comes to tariffs, but I think the market has started to shrug this off, right? And I think, especially, if you talk about AI infrastructure, a lot of it is, it's been driven by enterprise. So the tariff impact is not going to be as significant because I think if you talked about consumer, there will be a bigger impact because consumers are going to feel that immediate impact of tariffs.
On a thermodynamic basis, where does the energy come from out 5 years, 10 years to just appease your industry? I mean, where do you have a worry like a lot of other people that the electricity just won't show up to make all this stuff go?
I think it is an issue that people talk about, but we haven't really seen that really materialize yet.
Right.
I do think the infrastructure build will continue. I think everybody recognizes the importance of AI right now and why it's so important to invest in. For example, if you look at sovereign AI right now, the announcements earlier in the year about Saudi Arabia going to invest this huge amount of investment. But there's also the question of are they ready yet?
Right.
Because they need to build the infrastructure in terms of the energy. But I think it will eventually. I think it will go hand in hand.
A year ago, my book of the year, 2 years trailing, was Chris Miller's Chip War, which to me, as an ignorant one, was just fabulous. And Morris Chang was front and center through that. The eminence of Taiwan Semiconductor. Who's the next Morris Chang that HSBC sees on the Pacific Rim?
I think you're going to start to see some sort of, right now in China, what you're starting to see is that they are basically creating their own infrastructure, their own ecosystem, right? So you're basically developing almost two sets of systems, one for China and one for outside of China. Now in China right now, I think if you look at the foundry business, this SMIC is probably going to be the national champion in China, but there will be a lag in terms of
Will they have the sophistication of nanos, or are they more like a Micron, just crank out the chips?
They are doing foundry, which is similar to TSMC, but there'll be many generations behind. But what I think the Chinese industry has managed to do is to manage to be much more effective in terms of producing without having to spend as much money. They will not quite be at the equal footing, but they can make some inroads.
We say good evening to all of you across the Pacific Rim and good morning on your commute across America. Frank Lee with us. He's with HSBC on chips. Paul?
Frank, where are we? I mean, a lot of folks like myself, this AI thing, we're trying to get our heads around AI. A lot of folks are telling us, hey, man, think in the scale of the internet. Think this is the scale of like electricity. Where are we in that evolution of AI? Where do you think we are in that game here? How early or how late?
I think no one really knows the answer to that, but we do know that these companies, these massive hyperscalers, the way they're investing is unprecedented. And it's the first 2 years of the AI story was really just these hyperscalers, there's 4 or 5 companies investing. There was always this question about, well, can they actually make money? Can they monetize? That question is still being somewhat unanswered today, but it's clear that the spending needs to continue. But it's not just these hyperscalers now. It's clear that the enterprise, and even sovereigns are now looking at this.
We were talking about China, and it's become more and more apparent, I think, over the last 3, 4, 5, 6 years that there's this tech Cold War between China and maybe the rest of the world. A, is that accurate? And B, is that problematic? I mean, for just tech development, I mean, if you can't sell into China, or you're limited what you can sell into China, maybe we don't get some of the China tech coming out of China. How do you think about that?
Yeah, it's a very complex one, because you do see, with the latest change for the NVIDIA chip, they were banned earlier in the year, and now they're actually allowed to sell in. So it shows you, I think there's still a lot of unknowns, and I think both sides are still working on in terms of trying to figure out what's the right balance. And then if you look at where China has done really well is the EV. I mean, the EV industry, they pulled their own semiconductor industry with it, because a lot of the chips that go into the Chinese EVs are now being produced by Chinese companies.
But those are basic chips, right?
They're not as advanced.
Back to the micron model.
Right. They're not as advanced as the NVIDIA chip that goes into AI.
I know Nicholas Collison covers Apple for you. I don't want you to give me a buy, hold, sell on Apple. But do you just assume that the technology, the nanoness of Apple and others like Apple just continues, that we continue to see technological innovation down to minimum nanos?
Well, I think if you look...
10 to the minus 9.
Oh, boy.
Yeah, I think if you look at particularly a company like Apple, right, one of the challenges that you see they're facing is their AI angle is not very clear right now, because it's very much driven by consumer and iPhones.
Right.
So this is ultimately the problem today, is that the AI investment is all on infrastructure.
Okay, I got to get you in trouble here, so you can't go home. You're going to stay here and be with us once a week. Frank Lee, Apple's just got to do an agreement with somebody who's very AI, right? Why do they have to do their own AI?
Well, I think right now they made a push for AI. They basically talked about Apple Intelligence last year, but it didn't stick because it hasn't resulted in selling more iPhones. But what's very interesting is this morning there's talk about a foldable iPhone coming perhaps next year. So will that be the start? Because I think a year and a half ago, 2 years ago, everybody thought ultimately we're going to have AI PCs, we're going to have AI smartphones, but that hasn't really materialized. Like, people are saying, well, do I need to change my smartphone?
So who's going to cut to the chase?
Yeah.
No one's listening. Compliance isn't listening. Frankly, who's going to win?
Who's going to win what
the AI race?
Right now, it's the people that do the picks and shovels. It's NVIDIA, it's Broadcom, it's all the chip guys. Because they're making money and there's no angle of monetization, so people are spending. We
got to do one stock with Frank Lee just to get him in trouble. EMC is not EMC of Boston. Good morning, 92.9. Elite MC 2238TT or whatever.
Yeah.
Who is this tiny company in Taiwan? I don't know.
It's interesting. This company they make what they call as very upstream material, as a CCL laminate. And it goes into all the high-end chips, right? So what NVIDIA is doing right now, this is one of the very upstream components that sells into it. So again, it's a very niche area, but it's an important part.
Did I do okay there?
Yeah.
Did I nail it? It's just amazing how dumb I can be.
No. I mean, it's very impressive. You know this company, so it's a very upstream company.
Well, that's the way we rock and roll here. I think we need to be in Hong Kong. I got 30 seconds. We're hearing Hong Kong is beginning to adjust to the politics of the region. Is there a change in new Hong Kong now?
I think there's been a renewed confidence in Hong Kong and in China in general since the beginning of the year. I think the last 2 years, the last couple of years, it's been a very tough time, but it feels like they're turning the corner, right? And so you see there's a lot, especially after DeepSeek, that gave a lot of people in China confidence. Right. Because they now feel like, look, we have an AI solution, right? It may not be the best solution as US, but it's a solution that works for us.
Yep.
Right. Thrilled to have you with us in our studios. Frankly, thank you so much.
Thank you.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
So I cheated. I looked at Jordan Rochester's research, out at Mizuho. Then I cheated a second time. I looked at LinkedIn, where he had a glorious update out at LinkedIn.
Okay.
Thank you, Mizuho, for letting Mr. Rochester do that. Over the weekend, LDP, in power for 7 decades, sort of out the door within a goofy parliamentary system. Here to explain strong yen an ever stronger yen. I think that means weak dollar. Jordan Rochester, Mizuho. Frame out the yen move. In a year from now, Jordan, where can the yen be?
Good morning, everybody. Well, look, I think dollar yen's going to be on a 135 to 138 handle in a year's time. That's sort of where we'll be trading. And that's predicated, Tom, on the Bank of Japan raising rates. And that's still on track.
Does that destabilize Japan, and particularly the inflation that caused the anger of the voters, particularly on the core staple rice?
It should bring down goods inflation. So it should be benefiting the Japanese consumer in that way. It'll be dragging on the Japanese exporter, so it will harm profits. But the difficulty for the Bank of Japan, Tom, has been, as you kind of mentioned there, rice inflation, food inflation has been one of those things that have made the BOJ wrong-footed for most of this year. We've had CPI prints. We've had about 7 of them now this year, but for 4 of them, they've come in stronger than expected. And that's thanks to the food inflation, sushi, rice prices, and the correlation between a stronger yen usually leads to lower inflation for Japan. We haven't had that in the past 6 or 7 months.
So Jordan, is that the reason? I mean, I think a lot of folks hearing that the Bank of Japan is raising rates seems kind of out of step with the rest of the world, where many of the central banks are cutting rates, including potentially here the Federal Reserve a couple times here in the U.S. this year.
Yeah, Japan has completely decorrelated itself from the global monetary cycle. It's quite rare, actually. It's usually all central banks go up and down in rates in line with whatever the Fed does. But Japan's had a very structural big shift in its labor market. That we had a lot of FX depreciation in previous years that essentially released the genie from the bottle. So inflation is out there. Inflation expectations amongst firms and households are higher than what they are. And what Japan's long-term story has been, it's been about demographic decline and a shrinking labor force. But what we're seeing now is demand for Japanese labor going up. We're seeing record exports of semiconductors in Japan, for example, but the labor force has been shrinking. And so combine that together, you've got stronger wage growth, and that's the genie that has been released from the bottle.
What is the significance, Jordan, as a student of this? I think of Robbie Feldman over at Morgan Stanley as well. Jordan, you're a huge student of this. What's the so what for the United States if we get strong yen, LDP in the parliamentary system destabilizes? What's the so what for someone living in Des Moines?
What a great record so what is. One of the fun ones I've actually bothered to learn. In terms of what it means for Japan, Tom.
What's it mean for America? Des Moines.
What it means for America.
Jordan, help me. Stop the show.
You threw me off with a Miles Davis reference, I'll be honest.
Jordan, Des Moines is in Iowa. Okay, it's not north of Shogun. Okay, what's it mean for Iowa?
Well, it means that Japanese exports are going to become less competitive if you have a stronger yen. And it means that the US car industry will have something of a bit of a boon to it. You've also got to throw on top of the tariffs, domestic production of US cars should go up. So it should, combined, it's what Trump wants.
Well, Jordan, for years, nobody's talked about Japan until just recently. Isn't a little inflation or even a moderate amount of inflation, isn't that good for the Japanese economy in general?
If you asked Governor Ueda at the Bank of Japan, he would probably say yes. But if you ask the consumer on the street who's finding that their real wages are weaker, they would disagree. So it depends who you ask. But from an economic point of view, this is the moment we've been waiting for. It's why I start client meetings off by saying how excited I am about Japan. There is a structural shift higher in rates. There are trades to do. There's money to be made. But there are people who are struggling to put money together to buy their groceries. So you have to think about who you're asking.
Hugely valuable. Jordan Rochester, thank you so much, and really appreciate your effort on LinkedIn. Hugely informative. Had a FIC macro strategy from Mizuho, Jordan Rochester, in London on Japan.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our people emailed me yesterday and they said she's got like 14 minutes worth of newspapers. Should we get right to it,
Right
Paul?
to it.
I think we should. Lisa Mateo with the Monday newspapers.
Okay, this is something I noticed, but I wasn't sure if it was just me because I'm cheap or thrifty. Thrifty,
Thrifty,
as I like to say. Amazon is apparently quietly raising its prices. Back in April, it said it would keep a lid on them. So the Wall Street Journal, they looked into some e-commerce data. They found that prices rose on about 1,200 of the cheapest household goods. Even those that are made domestically saw some increases. A lot of them listed as everyday essentials. Few examples. So this is price changes from January 20th to about July 1st. The highest price rise was 136%. It was for this ear rinse for dogs and cats. I don't know what that's about,
okay.
but it's a big price increase. Visine eye drops up about 73%. Even some say it isn't so protein shakes. 25%. And what's more is that Walmart lowered their prices on the same items by nearly 2%.
Is there a why? Is it tariffs? Is it they just want to make, they're trying to make more money like they're
Well, the company is saying the products weren't representative of their prices overall. So they're kind of addressing it that way. But that's what this whole
2,500 items, I mean, that's pretty broad.
It's a big
I mean, that's the question. I mean, to the extent that tariffs impact prices, I mean, are companies going to take it in their margin? Or are they going to pass it on to consumers?
Right.
To date, it seems like they've been taking it in their margin. I guess the question for a lot of folks is, how long will that last?
Okay, quickly, there's never enough time, but Lisa, is Amazon a cardboard box company doing other stuff? Or is it a fancy cloud company moving boxes?
This way, I think if you're a consumer, it's the retail. If you're an investor, it's the cloud.
Next.
Okay, have you heard of the Gen Z stare?
This is driving me nuts.
Let me give you an example. I'll play it out.
Medicate
so let's say
me
you
here. Where's
go
the
up to the
Tito's?
coffee counter, right? And you ask for it, and they sit there, if you're watching on YouTube, and they go, and they just stare at you. It's this blank stare. Sometimes there's long
Does this happen
pauses.
in the Mateo house?
It does not, but I notice it when I go out and I see the kids behind the counter. They say, it's all the talk on social media, but they say, they talk to experts at them about it, and they say sometimes silence is the best way to handle, but they say the real big thing is that these kids grow up on screens. Gen Z is 13 to 28. So they grew up on screens. They're used to just staring. So that could be the issue behind it. But Gen Z says they don't even notice they're doing it. They're saying, it's overblown. We're not doing it. Even though their parents are telling them that they are doing it.
I go to Jeffrey Sachs with a great book 15 years ago, and we're 15 years on from his iconic statement on kids falling behind. And it's just been sped up with all this technology. Yeah. I read a 150-page book yesterday. Tiny book, not a big deal. How many kids are reading a book over a weekend? Like zero. We used to live on them.
Yeah, my daughter still has her summer reading project.
Your daughter was at MetLife partying until 2 a.m.
Zach Bryan, gotta be there.
Yeah, she came home and said, Bruce who? Next.
Okay, last time quickly, because we touched upon it earlier, the cancellation of The Late Show. It's talking about, with Stephen Colbert, is it the end to late night TV? So Screen Time, Bloomberg, Lucas's Shaw newsletter, said a couple of things. First, fewer people are watching. It's the most watched of the three major talk shows, but it attracts less advertising. And then he gets into the numbers. The show costs about $100 million a year to produce. It's on pace to lose more than $40 million this year, an additional $50 million next year. And the reasons they say why people are falling off is because a lot more people are watching the clips on YouTube or Instagram or TikTok. They don't want to watch the whole show. Short-term attention span. They just want the nuts and bolts of it. And then trying to get a host is hard because comedians can actually earn more money doing those, those stand-up shows that they do.
But James Kimmel's out in the Hamptons with his kids, right? We're waiting for the invite.
Exactly with Howard Stern. Hanging out.
Lisa Mateo, thank you so much. The newspaper. Did your daughter get home from the concert?
She did. I picked her up in the lot.
Oh, you did you?
Yes, the mom and dad lot.
Lisa Mateo, thank you so much.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.